important things, right? I think that we are way below, and we should consider this when looking for yearly highs. Think diminishing return side seem to have it right. Price seems to prove them right. Fundamentals, that's a tough one. I'm just going to lay it out clear. I want to talk about this. So if we're seeing diminishing returns, that window between 160,000 and 200,000. Yeah, if we trade under 200,000 and below, we saw diminishing returns for sure. There's no question about that, right? But when you say that price is well below, if you want to consult something like Charts BTC, who lays it out on his pinned tweet and shows exactly where we are. Charts BTC, by the way, instrumental into making all of this happen with the 4-year cycle, right? And you can line it up different ways. If you line price up from the halving, well, all right, well, we're not seeing diminishing returns. Nope, that's for sure, right? Well, then you line it up from the cycle bottom. Well, this is the one data point that you can make the case that we're starting to see diminishing returns. But if you're seeing diminishing returns, what you really should be seeing is this blue line, this red line, and then the yellow line below it. So that's reaching perhaps, right? And then you can look at the cycle peak, line them up from the cycle peak. Well, it's getting close, but we're not seeing diminishing returns yet. It's possible. What diminishing returns would look like though is not seeing volatility to the upside increasing than the previous cycle, less than the first cycle, not seeing the drawdown actually less than the last cycle, but it's more than the previous cycle, less than the first cycle. So it's an average of the two. And the consolidation period in the last cycle was less than it is right now. And this one was even more. So we're seeing this cycle so far being an average in each way of the previous two cycles. So the diminishing returns case at this point, that's like going back and saying Bitcoin shouldn't be above 20,000 in 2021, which was the base case for diminishing returns, if you remember. So, and then, you have our, Ted over here, the collective CTM model over here, Ian working together off of, my original vision, tightening it up over here with their expertise and beautiful. I mean, these guys are absolute nerds. I love it. I love them for it. And, this is, diminishing returns. You're looking at the first cycle, the second cycle, this current cycle being below that line over there, 160,000 was the math I did originally, putting out a price target for the Bitcoin 2020 cycle in the 2021 bull market phase using diminishing returns. But obviously it appears price is acting off of monetary policy, which is uber easy right now. It continues to be. At the beginning of the session, we looked at that's not really what's seeing. So yeah, why it's possible, that's not what we're seeing. The law of diminishing returns would mean as Bitcoin actually overtook the market cap of gold, if it was going on, to compete for that greater share of M1, eventually it's going to reach a place where you're going to see those returns become diminishing. But this thing is a tiny asset right now. This thing is like an $800 billion asset. And you got institutions jumping in here, making moves and getting involved. I mean, the speculation, you're an early adopter right now. If you're in the market, you're an early adopter. So the law of diminishing returns is something that should be taking place later on. The law of diminishing returns you're seeing happening in QE. With the amount of money the Fed throws at this thing is just having a diminishing effect, right? Does that mean that actually, as it has a diminishing effect, as fiat continues to get devalued, what you're going to start seeing is actually an increase in returns in Bitcoin as it becomes that black hole that sucks it all in? Probably. So, I mean, good thought. But let's take a look at this objectively. Let's say, listen, if we had a 39x using the halving, right? This is block count after the halving, lining these cycles up from the halving, and we had a 39x in the 2012 cycle. It's here in blue. In red, the 2016 cycle was a 17x. That's basically 1/3 less the return. right? Not only that, you could see that this cycle is about 85 days later. When we talk about lengthening cycles, we're not talking about a period, call it a deviation of 85 days or so, right? Plus or minus. When we talk about lengthening cycles, we're talking about actually cycles starting to lengthen, right? So anyway, look, when I did in November 2019, and I put out what I thought the 2021 bear market peak was going to be, I used diminishing returns, and I saw that we had 1/3 the return from the 2012 cycle, and I said $160,000. Take 1/3 of the last cycle, you have $160,000. That's diminishing returns. $140,000. Make that your goal. Mission accomplished if price reaches that target. What changed? It's been the Fed's uber easy monetary policy. It's actually caused this current cycle that we're in to be an average of the past two cycles. We're not yet seeing diminishing returns. If we were, this white bar over here, the current cycle, would be below this last one over here, right? We're in the mid-cycle dip. It happens to be greater than the previous cycle's mid-cycle dip. But again, it happens to be less than the first cycles. It's an average of the two on the upside, on the downside, and also consolidation. Could it change going forward? Of course it can. Of course it could change. Now, looking at two data points, right? Looking at the 39x and then the 17x and being like, see, lengthening cycles, diminishing returns, right? Anyway, let's actually clarify this. Let's talk about diminishing returns over here right now. We don't need to get into lengthening cycles in this particular moment. You know, two data points, diminishing returns. Data says it all. Is that authentic, right? Why are you choosing to look at those two data points, and why are you not looking at the data points of the past two cycles? Because we have two data points here, and they're 4 years long each. It's the 4-year cycle, right? And it's the halving event every 4 years that sets off this 4-year cycle. If you want to look at diminishing returns and two data points, then you also need to look at the two data points of the 4-year cycle, and you have to say, hey, listen, there actually is a 4-year cycle. If I could look at two data points to say diminishing returns, you should be able to look at two data points to say 4-year cycle. Actually, you got a catalyst for yours that would trigger that those two data points and the 4-year cycle, right? If at any point in time we deviate from these, here's 85 days difference in length between the cycle peak. You know, if we were to peak less 85 days or more than 85 days, I wouldn't call that shorter cycles or lengthening cycles. I would say that's the deviation we've seen so far. And now we have a third data point. It's helping us go forward, right? But what we are seeing so far to date is this current cycle in blue, the 2020 cycle, continuing to be an average of the previous two cycles, both to the upside, to the downside now, and also in the amount of time it consolidates. Here it's shorter, here it's a bit longer, and here it was really long, the consolidation period. Here we're really strong to the upside, here we're not as strong, and here we're stronger than this past one, but not as strong as this one. Here on the downside, this 40% dip, yep, it's this 50% dip mid-cycle is greater, you know, but it's not as bad as this 70% dip over here, or the 83% dip from the top peak over here to the mid-cycle shakeout. There's a difference between its cycle, but we're seeing this current cycle continuing to be an average of two. What might be causing that? Could it be the Fed's policy? We have over here, we have 100K to 100 million breaking down what was taking place this cycle and past cycles. Right now, we're currently looking at the Fed looking to potentially hike rates next, right? And then we're also looking for when the quantitative easing tapering will take effect. Jay Powell yesterday, right? They're not looking tapering yet. That could change. We could get a new signal come August in Jackson Hole, Wyoming. We could get a new signal in the November meeting. But as of right now, they're keeping on pace with $120 billion in QE purchases. Does that affect the cycle peak of this Bitcoin bull market? It doesn't look like it so far, right? Now we could go back to 2013 when we had the QE3 tapering talk, right? And look, the QE was going on. This was a hyper aggressive, diminishing returns I talked about in QE in this episode, right? The amount of QE they need to initiate is having a diminishing effect as the debt gets bigger and bigger and bigger. In 2013, the QE was really powerful. Look what it did over here, right? There was no QE in 2016, okay? There is QE right here in 2020. Let's keep going over here. What else does 100K to 100 million say? So what about in 2016? In 2016, we saw one rate hike in December 2016 and 3 more hikes into 2017 during the bull market. With monetary policy not so easy, look what Bitcoin did in 2016, right? It had this beautiful 17x, right? Not as big as the 39x when QE was running hot and heavy and was having a more of effect before diminishing returns was taking effect. The law of diminishing returns is real, right? What about right now? We're looking over in 2017. During that period, we saw that Bitcoin still did its thing, but it had less of an effect. Right now, in the current cycle, 2021, the 2016 4-year cycle, the Fed is not yet hiking rates. By the way, when Fed started hiking rates and was hiking them, it didn't derail Bitcoin. Did it have a bit of a suppression effect on it? Perhaps. As we get more information, more data, we'll be able to make up our minds a little bit clearer. But right now in 2021, the Fed's not hiking, right? And QE is still going strong. And what we're seeing is an average of the two. That's the best base case I can give you of why Bitcoin in the 2021 bull market here is so far performing as an average of the past 2 cycles. Because the monetary policy, it's all about the Fed. Right? It's all about the central banking system. And in 2016, under tighter conditions, Bitcoin didn't perform as well as in 2013. 2013, yes, Bitcoin was a smaller market. There were less participants. There weren't people taking there weren't public companies taking $1.5 billion positions, right? It's different. The market's more mature right now, but there are bigger players, and the market is only $800 billion. It's really, really, really small. It's a really small market still, but you're seeing big players step up. But what's going on is the monetary policy. It's super easy right now. We have QE running hot. We have interest rates really low. And even if they start to raise rates as early as the third quarter 2021, Bitcoin is expected to continue performing well. The rate hikes did not derail it in 2017 bull market. So here we are, looking at diminishing returns. Be careful. Be careful. Look, it's true. And, I know that some people looking for diminished returns are looking for 100,000, perhaps, 10 or 20 or 30,000 above that. Even if we have $160,000 in this cycle, that would be diminishing returns. We would be seeing returns diminish by a third each cycle. If we had $200,000 price target, cycle peak, that's still on the borderline. I would still call it personally diminishing returns. I would still call it diminishing returns. Above there, clearly we're not seeing diminishing returns. We're seeing increasing returns. We're getting there. We're all going to work it out together. I think from whatever angle, whatever vantage point you're coming out, I think that you just really want to be on the right side and see things clearly. In the end, we're all going to the same place.